the spread, the strike price difference between these two options is $5. So our maximum profit is $2.40 minus the $5, which is the difference between these strikes, which is $2.60. And that's exactly how they calculated our maximum profit in the dialog box. Our maximum profit is $2.60 on this spread. Our maximum loss is $2.40, or $240, which is $2.40 per spread, which is the exact amount that we paid for the spread. Okay, so the most you can lose in a vertical spread is exactly what you paid for it. That's the maximum amount of money that you could lose. You can't lose any more than that. But you might be asking yourself, well, especially if you're a total beginner to options, is if the price is $2.40 and we're only buying one contract, why are we paying $240? Well, the reason that we're paying $240 and not $2.40 is because each contract, and this is true for every single option except for some exotic European options or some other exchange options. It's true for the majority of the stocks or indexes that you'll be buying, is that a single contract, single option contract, actually gives you the right to purchase 100 shares of the underlying stock up to the expiration date. So one contract is actually equal to 100 shares of stock. So when you look at a price of an option, or in this case the price of a spread, you would take the $2.40 that you're buying for paying for the contract, multiply it by 100 to determine what your actual cost of that option, or in this case the spread, is. And that's why we're paying $240 and not $2.43 or $2.40. So that is also, that's exactly how you would determine your break-even points, your profit on this position, your maximum loss, and the cost of the trade. Now, remember this cost of $240 plus $3 in commission for a $243 total cost. Let's close this out just for a second. What happens if we try to get this at the mid-price? Well, if we try to get this at the mid-price, which is considered to be a wholesale pricing, our maximum profit now has jumped from $260 to $280. That's because our maximum cost of the trade is now only $220. If we take the $2.20 and subtract it from the $5 of our vertical spread, well, now we have a potential profit of $280 on that spread. And since it's only costing us $220, our maximum loss now is also $220. With the $3 commission, it's going to cost us $223. So it actually saved us, by trying to enter this order as a spread instead of individual orders of the options, it saved us $20 on this one order. Okay, that may not seem like a lot. However, if you enter enough of these orders over the period of a year, that $20 can add up very, very quickly. Let's just give you an example. If you were to put a 10 lot on these, let's see what the difference in the price is. If we were to enter this at the retail price of $2.40, we would be paying $2,400 plus $30 in commissions, or $2,430. Our maximum profit is $2,600. If we bought this at the mid price, we have shaved $200 off the price of our spread, and now our profit is $2,800. Our maximum loss is only $2,200, which is the cost of the spread plus the commissions, or $2,230. So you can see that not only does trying to get the mid-price help us save money, it's really wholesale pricing of the options. Now, like I said, you're not always going to get it at the mid-price, but guess what? You could even shave the difference between the mid price and the natural price and try for $2.30. If you couldn't get it at the mid price in the beginning, you'd still save quite a bit of money on this 10-lot order. It's a $100 savings if you can get it cheaper. Even on a 1-lot order, you could save $10, and those dollars do add up. So that's a very, very basic understanding of spread orders and why we do spread orders. Let me just show you one additional feature of and benefit of entering spread orders instead of individual option orders. Let's take this out for a second. I'm going to go back to here, and let's say we wanted to enter the spread as individual options. So we're buying that one, we are selling that one. When we enter these orders, we have a couple of different options available to us in our dialog box. We can blast all, we can have a first triggers sequence, or we can have a first triggers all. So if we purchase this one, then it will trigger the sale of this one. But what happens if the market accepts the order on this price, but it doesn't accept the order on this one? So it accepts the order that we're buying, but the price moved after this one was entered, and now we can't get this one for $1.70. Well, what happens to our spread? Our spread may widen or it may decrease. We don't know, but we're not going to get the other leg of this order in, and all of a sudden, instead of paying $2.40 for this order, we may have to pay $2.50 or more for this order, or the price may go against us, and all of a sudden our long call here may be worth less money, and we didn't have the protection of this short call in order to help offset the loss on this long call. The calls that we are buying are called long. Usually they're long, long calls, long puts. Those are the ones we're buying. The ones that we're selling, we call those short. So we're either short the call or short the put. Those are the ones that we're selling. That's just the terminology that people use when describing if they're long a call or short a call. So you can see that when you put in these type of orders, that if you do them individually, you have more risk than if you put them in as a vertical spread order. You may get a higher price or a lower price if you try to play around with it, but if the market moves dramatically against you, then you might get hurt. You might end up paying a lot more for that spread than you should have, or the price will move against you and you'll lose money. So it's always best to put these orders in as a spread. You'll always get the best price, the best execution, and you don't have to pay retail prices unless, of course, the market is not going to be very forgiving, and then you try to. But at least you can always try to get the mid price or the wholesale price before you start raising your prices in order to get the position on. So that is a vertical spread. That is a simple vertical spread where you're purchasing one call and selling another. We can do the same thing on the put side. We can also buy a vertical spread on the put side. So instead of calls, if we believe that the market is in the stock is going down, if we believe the stock is going down, we can purchase one put at a higher strike price, sell a put at a lower strike price. In this case, it's the 80-75, and we call this a bearish vertical spread because we're buying puts and we want to profit when the stock goes down. In this case, the debit is $2.85, which gives us a profit of $2.15, which is the difference between the strike prices, which is $5 minus the $2.85 that we paid for the vertical spread, and it gives us a profit of $2.15 if the stock moves down below 75 or below on expiration. So if we go ahead and bring up the dialog box here for the order confirmation, you can see that the maximum profit is $2.15. Maximum loss is exactly what we